Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Buckle up for safety, buckle up. Buckle up for safety, always buckle up. Put your mind at ease, tell your riders please. Get your seatbelts buckled, everybody buckle up.
Think buckling up for safety back in the 60s was important. Just wait till you see how important it is to buckle up for the tax law changes getting ready to crash into your plans to a worry-free retirement.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, nationally recognized retirement specialist and six-time author and fiduciary, Tony Walker.
Now that Congress has passed the Fiscal Responsibility Act of 2023, it isn't too soon to start thinking about the mess lawmakers have created for themselves and our wallets in the year of our Lord, 2025. That is because as the current tax laws are written regarding the taxes you will owe on that tax-infested 401k, IRA, or other retirement accounts, lawmakers have granted us taxpayers a short-term, let me repeat, a short-term reprieve from Congress's self-made debt limit crisis. Problem is, this temporary reprieve now sets the stage for more long-term problems as the year 2025 fast approaches, a year whereby current low tax rates will expire, thus allowing for the potential for much higher taxes on your 401k, your lump sum pension, and of course any other pre-tax accounts you might own. In other words, in 2025, we could see taxes go up drastically, just at a time when Americans need more and more of their money to live on. And we are not talking about chump change here, but the idea of trillions of dollars that will need to one day be paid back, and the obvious solution to this debt crisis of where that money might be found to pay back our nation's debt. That's right, the money you have worked so hard to save, currently buried inside that tax-infested retirement account of yours. You see, the time between the date of this recording of this show in October of 2023 and the upcoming year current tax rates expire, the year 2025, promises to be a painful lesson as to what can happen when Congress confronts the consequences of temporary tax policy, even as it tries to satisfy ambitious but deeply conflicting goals. So what is included in the individual tax provisions of the 2017 Tax Cut and Jobs Act? And what can you expect of this potentially disastrous expiration date of these current tax laws in 2025? Well, we're going to find out. Well, hello there. I'm Tony Walker, and welcome to the Worry-Free Retirement. That's right. I'm that little man in the sweater vest, 401k tax planning specialist and fiduciary. And before we share with you this expiration of this current tax law in 2025, and what it could mean to your pocketbook and why now is the time to get a game plan in place to deal with these taxes, let me introduce two folks in the Worry-Free studios who love paying their fair share in taxes each week. America's favorite financial sidekick, Mr. Aaron Orander, along with Louisville, Kentucky's most laid-back graphics artist, Mr. Derek Hudson. Okay, it was this article that took me back in time to the idea of that cute little jingle many of you might remember back in the 60s about buckling up for safety when driving down the road. As this article reminds us that in 2025, with the current tax law set to expire, those of you with 401k plans are going to need to buckle up as most financial experts are predicting taxes will go up in 2025. So with that said, let's take a long, hard look at these current very, very low tax rates. Rates at which you will be taxed when you go to spend money that has been tax deferred inside 401k plans, 403b plans, TSPs, IRAs, and yes, even a lump sum pension. Take a look. You got it? Okay. Now imagine you are that politician in Washington trying to figure out how in the world you're going to be able to pay back all of the debt you've helped rack up in this country and where the funds to pay off that debt might come from. If that were you, wouldn't you consider looking for money that has not yet been taxed? Well, of course you would. And where might that money be found on a whim? That's right, inside your retirement account. And therein lies the concern for most savers I meet who realize that when the current historic low rates expire in the year 2025, there is that very real possibility that taxes will go up or at least very easily go back to pre-2017 levels of higher taxes. But you still have time to get a jump on 2025 by getting with someone such as Tony Walker Financial to create a plan now versus waiting around to see what happens. Which is why today we are going to first explain what could happen in 2025 and how we at Tony Walker Financial can be of help in trying to keep more of your money in your pocket. So buckle up and stay tuned as we first explain what these tax brackets mean and how we at Tony Walker Financial can try to keep you in lower brackets. We'll be right back. In the financial world, advisors are often divided between two categories, money managers or annuity specialists. My question is, why not have both? At Tony Walker Financial, we specialize in investments and securing guaranteed income you can never outlive. You know, we're more than just annuities. So if you're retired or retiring soon, why don't you give us a call or log on to TonyWalkerFinancial.com and let's get started. Welcome back to the Worry-Free Retirement. As we begin this segment, I want to stress that today we are enjoying some of the lowest income tax rates I've seen in my nearly 40 years in this business. And with that said, since these low rates and tax brackets will expire in just 2 years, I thought it would be helpful to now turn to one of our certified tax specialists in our Bowling Green office, Miss Leanne Tinsley, to summarize the 5 major changes that will occur when these laws expire.
Right. So the first one is the individual income tax rate, which is going to revert back to the 2017 levels. This is going to affect the most people, in particular those with over $250,000 in their retirement accounts. In addition, the standard deduction is going to be cut roughly in half. The personal exemption will return while the child tax credit will be cut. The estate tax exemption will be reduced.
So let's focus on the first major change that Leanne shared with us, and that's the one that will affect most people who have at least $250,000 or more in their retirement accounts, and that's the increase in these tax brackets. Now, what in the world do we mean by tax brackets, and why would someone with $250,000 or more in retirement accounts need to be aware of what will happen in 2025 when the current rates expire? Well, let's do this. Let's take a look. Now, this is going to get a little complicated, but you really got to stay with me on this. This is really important stuff. So these are the current rates for the Tax Cuts and Jobs Act, which will expire in 2025. So let's start there. What this means is, and we're assuming a married couple filing jointly, that if that couple makes over $0, this is taxable income, between $0 and $19,000 a year, that portion is going to be taxed at 10%. You with me so far? So let's just say you were living on Social Security. Much of that wouldn't be taxed if you had minimal income from other sources. I've seen this happen. You would only be taxed at 10%. Not bad. Well, how does that compare to 2017? Well, if you'll notice, no changes. If you're between $0 and $19,000 a year of earned income in retirement, you're only in a 10% federal tax bracket. No big deal. Okay. Let's keep going though. Let's say you make more money than that, so you go to the next level. By the way, tax brackets, people get confused on this. The level of income right here will never change. That's taxed at 10%. This is why we call it tax bracket creep. Watch what happens here. So let's say somebody's taxable income is $40,000 or whatever. That next portion of money goes in anything over $19,000 up to $77,000. Now that percentage of income is taxed at 12%. It's a 2% increase. You see what's going on here? We say, that's still pretty low, isn't it, Tony? Yeah, it's really low. But look what happens. If these tax laws, when they expire, go back to 2017, notice that it's a 15% rate. That's a 5% hike on that additional money, not 2% hike, okay? This is going to add up, as we'll see maybe possibly later on if we have time. Let's go to the next level. Let's say you say, well, I make more than $77,000. What happens if I make more than $77,000? You go up into this bracket currently, and these are the ones that are going to expire in 2025. That portion is taxed as 22%. Now, that's a 10% jump. Now we're getting up there. That's some serious change, all right? 22% on that portion. But what if these laws expire and they go back to 2017? Look at that. The jump is going from 15 to 25. Now we're starting to add some additional layers of tax dollars that are going to be due to Uncle Sam that we don't have to worry about now. These are starting to get to be some big numbers. We're going to see an example possibly in the next show of somebody who wanted to take out a large amount of money from their 401k to consider paying off their home. Okay, this is where this would come in. What if somebody is making more than $165,000 a year? What tax bracket do they creep into? Well, in this case, under the current laws, doesn't go up a lot. It goes from 22% to 24%, which again, that seems like a lot, but historically speaking, in fact, Aaron, put this up full screen. Remember, folks, back years ago, taxes got as high as 80 and 90% years ago. So are we going to get that high? I don't know, but if you compare 22 and 24 to 70, 80, and 90%, this is why I say we are at historic lows. So again, tax laws are going to expire. Let's say they go back to pre-2017. Now that portion of money is taxed at 28%. So we have 10, 15, 25, 28. That's the old law it could go back to versus 10, 12, 22, 24. So what is the solution to all this mess? Well, the solution is certainly not to sit there and do nothing. No, the solution to this act that's getting ready to change is for you to act now. And how do you do that? It's easy. You just pick up the phone and give us a call, or better yet, log on to TonyWalkerFinancial.com. And what I want you to do is take advantage of something we call the free 10-minute fiduciary phone call. And all you do is pick up the phone, give us a call, log on, click on that red box, whatever's most convenient. We will arrange that 10-minute phone call with myself or one of our highly trained salaried fiduciaries. So log on now, TonyWalkerFinancial.com, or give us a call. All right, when we come back, I'm going to set the stage for next week's show because we're going to talk about 3 case studies, different circumstances, different amounts of money, and we're going to show you what happens when you start dragging money out of that tax-infested IRA and what the taxes would be now versus in 2025 when these laws expire. Good stuff coming your way. I'm Tony Walker. We'll be right back.
Hi, my name is Heather Hughes. I'm an advisor in the Bowling Green office at Tony Walker Financial. Just wanted to talk to you a little bit about the decision to retire. That's probably one of the major decisions you're ever going to have in your life. And to have the right advisor to help you through retirement is of utmost importance. Keep in mind that you really do need to work with a fiduciary who is legally obligated to work in your best interest. Additionally, you are going to want a game plan for your retirement so you can navigate through everything. And look at retirement as a partnership with your advisor, somebody that you'll be able to work with throughout retirement. And if you have a spouse that they feel comfortable working with too. Here at Tony Walker Financial, we can do all of those things. Thank you so much.
Have you recently retired, been laid off, or offered a pension buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no obligation appointment. Let us help you today.
Buckle up for safety, buckle up. Buckle up for safety, always buckle up. Put your mind at ease, tell your riders please. Get your seat belts buckled, everybody buckle up.
Welcome back to the Worry-Free Retirement. I am Tony Walker. And you know, all this talk about buckling up for safety really pertains to our message today, which is buckling up for these future taxes possibly going through the roof and the expiration of our current low tax rates just around the corner in 2025. With that said, I thought it would be a good time to kill two birds with one stone by placing a Zoom call to one of our newest staff members at Tony Walker Financial, Mr. Craig Davis. And Craig's going to tell us how we can help you, for those of you who have 401ks, lump sum pensions, 403bs, how easy it is to consider moving those funds over to Tony Walker Financial so that you can get a game plan in place now to deal with the looming tax laws that are getting ready to change in 2025. Well, good morning, Craig.
Good morning. Thanks for having me.
Oh, you're welcome. Been with Tony Walker Financial for just about 2 months now, and I've already got you on a Zoom call. We appreciate it. First of all, how's it going since leaving the mortgage business and joining the ranks of Tony Walker Financial?
I'm enjoying it quite a bit. Love the opportunity to help families, especially with these 401k rollovers. They can be a little complicated sometimes to try to do on your own.
And you have really taken to task the ability to help people feel comfortable when they decide to move money over to Tony Walker Financial. So please explain this 401k rollover process to those who are thinking about moving money to Tony Walker Financial.
We'll normally start with a phone call. We verify information, get security questions out of the way, know that we're talking to the right person, and then we'll place a conference call with the current custodian, whoever has maybe their retirement funds or 401k, and then we will just help walk them through the process of what kind of rollover we're doing, where those funds are going. We have all the information on our side, so the client can just be they can be at their current job, they can be out at a shop, something like that, and not have to worry about having all the details right there with them. We handle all the heavy lifting part for them. They answer some security questions for the company, and typically in 15 minutes, we can get it finished.
All right, in the essence of time, we're not going to have time to cover the exact details of these cases. I've decided to reserve that for the whiteboard for next week's show. So what are these three cases that I had one of our tax certified specialists in Bowling Green take care of? That's Timmy Reagan. I got to go get Juanita. Derek, I'll be right back. Timmy, thanks again for your help, man. Is your name Timmy?
No, my name's not Timmy. I don't like being called Timmy. I've never been called Timmy.
And how would these three different examples be impacted if we consider what's going to happen in 2025 when these tax laws expire, and should Congress go back to 2017 with these higher brackets that once existed? So let me go into detail the three case studies we'll be doing next week. This is very interesting. Now, age 73 is an interesting age. That's called your required minimum distribution. It used to be 70 and a half. So now you got to wait till 73 if you want to wait to take them. But the problem is those RMDs, those pre-tax accounts that have to be paid out, have to hit your tax return. So our first case we're going to look at, it's going to be a married filing jointly couple. Their taxable available income is $77,400. In this example, they're going to have an IRA of $500,000. Now, TJ has calculated their RMD. What that means is they have to take out at least $18,867. They could take out more, but let's just say they don't want to pay the taxes, they don't need the money. What is the minimum RMD? That's it. And then we're going to talk about the taxable income and what all that means today versus if we go back to 2017. That's the first case we're going to take a detailed look at next week. Case number 2, same thing, all right? Same exact situation, a 73-year-old couple. They're approaching their RMD age, but it gets a little different here. Notice their taxable income is around $156,000. And you might say, well, Tony, where would all that income be coming from? Well, there's lots of things. They could have pensions, Social Security, rental income. I mean, there could be some other income coming in. Maybe they'd been doing some Roth conversions. Who knows? But those incomes are up. Well, what that means is, too, as a way of having more income throughout their life, they've got a bigger IRA. It's got $1 million in it. $1 million IRA. Well, if you calculate the RMD on that, and RMD is really just a calculation of your current amount of money in all qualified accounts, it's multiplied by a factor that the government requires you to apply to this amount of money. So in this case, their RMD this year is going to be $37,735, and obviously higher taxable income. So again, next week, We're going to look at this case. What would the taxes on this money be now? But after 2025, when these laws expire, if they go back to pre-2017 taxes, how much more in taxes is this couple going to pay? Now, our last example, this is really an interesting one. A lot of people come to me. Now, remember, we're not working with investors and speculators. We're working with savers. And most savers do not like having a lot of debt in retirement. And I get it. I agree with that. In most cases, it's better not to have debt because remember, as somebody who specializes in retirement planning is more about cash flow. It's not trying to grow your money and taking all this risk and trying to budget and all this. That's not what we're doing. We're trying to manage our cash flow, what comes in the front door and out the back door. So obviously, if you don't have a bunch of debt, that's more cash flow that we can manage and less money we have to come up with and possibly pay taxes on to make that monthly payment through retirement. So yes, in most cases, if a saver really wants to pay off their home, we're going to try to help them do that, but there's tax consequences. So in this example, same situation, the couple's 65, currently they have taxable income of about $89,000, and they got $1 million IRA a 401k that they've rolled into an IRA with Tony Walker Financial to manage. But they say, hey, what if, Tony, we paid off our current mortgage on our home of $250,000? Could we do that? Well, the answer is, of course you can do that, but we need to understand the taxes. Plus, if we did do that now versus waiting to 2017, what would be the tax ramifications of waiting till pre-2017 limits after these laws expire in 2025? There's going to be a big difference on this one. So folks, this is what we're talking about. In the meantime, if you're sitting there saying, Tony, I'm not going to wait till next week to see how these things play out. I want to get a game plan now to deal with these taxes before they go up in the next couple of years. You can take advantage of our services and our expertise in retirement planning and tax planning by simply going to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com. Take advantage of arranging a free phone call with myself or one of our highly trained fiduciaries. Just log on to TonyWalkerFinancial.com, click on that Let's Get Started, or feel free to give us a call at the number on your screen. Well, speaking of taxes, it's always interesting to go back into the Bible and see what what they were worried about back then. And one thing they really hated back then was paying taxes. But what's surprising is when a bunch of religious leaders asked Jesus whether they should pay taxes or not, his answer might just surprise you. I'm Tony Walker. Let me get another cup of coffee on this one. I'll be right back.
Are you retired or retiring soon? Do you have a 401k, IRA, 403b, thrift savings account, or lump sum pension that you'd like to move to safer territory? Did you know that all the money you see on your 401k statement isn't really yours? Depending on your overall taxable income, the government has essentially a lien on your 401k that can tax as much as 40% of your money when you go to take it out. Tony Walker calls this the 401k tax tumor. For almost 40 years, retirement specialist Tony Walker has helped thousands of savers worry less about money by creating game plans to deal with your tax tumor. Get control of your retirement by controlling the taxes owed on it. Schedule a free meeting to see if you can reduce your tax tumor and provide a guaranteed income you can never outlive. To get started, simply log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com.
One of the more interesting exchanges regarding the amount of money Christians are expected to hand over to the government in the way of taxes is found in Mark 12:14 through 17, where some religious leaders who are clearly fed up with Caesar taxing them to death decide to see if they can corner Jesus into getting them off the hook by asking whether it is lawful to give up their hard-earned money to the government. In usual godlike fashion, Jesus does what he does best, answers the religious leaders' frivolous question with a question. This one where he turns the tables on them by asking them to drag out a denarius and then say whose inscription is on the coin. After the religious leaders note that it is that of Caesar's, Jesus then asks another question. Then why are you testing me? Interesting, don't you think? that of all the things Jesus sees playing out is not a bunch of religious folks sincerely wanting Jesus' opinion on whether they should obey the law of the land and pay taxes, but rather a bunch of hypocrites who have no intention of obeying any laws that affect their pocketbooks. It's a reminder what sin and greed can do to a man's faith in God. Of course, Jesus would have none of their hypocrisy, yet I would hope that if Jesus were here today, he might at least agree with the assessment of how much we must pay in taxes made by the late great Judge Learned Hand, who said this: "The law does not require one to pay more in taxes than the law requires." Fair enough. But Tony, you might be thinking, this still does not curb the resentment I feel every time I see my taxes go up. So what do you have to say about that? Well, my friend, here's my take on the matter. This money that you and I possess, yes, money that we worked our tails off to save, in the scheme of things has nothing to do with God and his thoughts on how much we should pay in taxes, but rather this money and our desire to hold on to as much of it as we can. It has more to do with the testing of our faith in God and whether he can meet our needs when others come to take our stuff away from us. This human desire to hold tightly to what we have and not be content with others taking it from us is addressed in Watchman Nee's masterful work, Love Not the World, where Nee summarizes it this way: "While we might do our best to hold tightly to our money, we must never grip that money so tightly as to overshadow our longing to hold on to what truly matters, our faith in God to provide all that we need." The Apostle Paul reminds us that it is not the amount of taxes we owe to Caesar that God is concerned about, but rather us being free from the cares of the world. It's also how we can learn to be content with what we have, because in the end, we must remember that we will not be able to take any of this stuff with us anyway. So here's my advice. Plan in such a way to save as much as you can legally save on taxes? Well, absolutely. But know this, dear friend, whether you will pay little in taxes or fork over more than you feel is your fair share, no matter what the future taxes might be, you hold tightly to your faith in God, and I assure you that he will give back tenfold that which you must pay to others. And that's some good news you and I can take to the bank. Amen? Well, how about you right now? You might be sitting there saying, "Tony, I didn't realize this whole 2025 thing was looming large and that taxes are more than likely going to go up." So how can you take advantage of something we call the free 10-minute fiduciary phone call to see if you're going to be affected by these tax laws in 2025? Well, that's easy. All you got to do is log on to TonyWalkerFinancial.com. And when you get there, there's a little red box you're going to click on, and that sets you in motion to set up this free phone call with either myself or one of our highly trained salaried fiduciaries. Then, after this phone call, if it warrants, we will be happy to meet with you in person to review your situation at absolutely no cost, no obligation to you, and we can do this at either our Bowling Green, Louisville, or Lexington, Kentucky offices. So do it now. Log on to TonyWalkerFinancial.com or call the phone number on your screen. Well, we hope you've enjoyed today's program, and we look forward to seeing you next week on the Worry-Free Retirement. But you remember, between now and then, if all else fails, you be worry-free and make it a good one.
Buckle up for safety, buckle up. Buckle up for safety, always buckle up. Put your mind at ease, tell your riders please. Get your seatbelts buckled, everybody buckle up.